The global auto industry was rocked to its core when a $6.5 billion deal between Ford and LG Energy Solution, intended to build a massive EV battery factory in Turkey, suddenly collapsed without warning. The news sent shockwaves through boardrooms and trading floors around the world, as this partnership was seen as a cornerstone of Ford's ambitious electric future. This plant wasn't just another factory, it was central to Ford's European electric car ambitions, designed to supply batteries for hundreds of thousands of vehicles each year and power the next generation of Ford's electric fleet. The abrupt cancellation left analysts and investors scrambling for answers, with many questioning what went wrong behind closed doors. Ford's production plans were thrown into chaos overnight, and the uncertainty rippled across the entire industry. Without these batteries, Ford's next-gen electric models, like the Mustang Mach-E, now face major delays. Production lines that were supposed to be humming with activity could soon fall silent, and customers waiting for their new EVs may be left disappointed. The collapse raises tough questions about the stability of the EV supply chain and Ford's ability to compete in Europe, where rivals are racing ahead with their own battery deals and factory projects. Ford has invested billions to shift to electric vehicles, betting its future on a new era of clean transportation. But this transition depends on reliable battery supplies, and any disruption can have far-reaching consequences. The Turkey plant was supposed to anchor that supply chain, a symbol of Ford's commitment to an all-electric future, and a key part of its strategy to lead the EV revolution in Europe. Now, Ford must urgently find a new partner in a fiercely competitive market where every automaker is scrambling for batteries, and supply is limited. The pressure is on to secure new deals before rivals snap up the remaining capacity. The void left by LG creates a massive gap in Ford's production timeline and exposes the fragility of the industry's electric promises. Every day without a solution means lost ground in the race to electrify. This isn't just a financial setback, it's a strategic crisis that could haunt Ford for years, affecting its reputation, its bottom line, and its ability to deliver on bold promises to customers and investors alike. The electric revolution, it turns out, is anything but smooth. For Ford and the entire industry, the road ahead just got a lot more uncertain and a lot more challenging. The Turkey factory was the linchpin of Ford's European EV strategy, representing not just a manufacturing site, but the heart of Ford's ambitious push into the electric future. It was more than a building. It was a symbol of Ford's commitment to innovation and sustainability in a rapidly changing automotive landscape. Ford's pledge to sell only electric cars in Europe by 2030 hinged on a steady, local battery supply. Without reliable batteries, the entire transition to electric vehicles would stall, making this plant absolutely essential to Ford's vision. The plant's planned capacity, enough for 500,000 vehicles a year, would have powered Ford's transformation. This scale would have allowed Ford to compete head-to-head with European rivals, ensuring that their EVs could reach customers quickly and efficiently. Its location was strategic, serving Ford's European factories and cutting logistics costs. Being close to key markets meant faster delivery times, lower emissions from transport, and a more resilient supply chain in the face of global disruptions. Partnering with LG meant access to cutting-edge battery tech and manufacturing know-how. This collaboration was set to bring the latest advancements in battery chemistry and production, giving Ford a crucial edge in the competitive EV market. The factory was to be a hub of innovation, helping Ford improve range, performance, and safety. It would have fostered new research, attracted top engineering talent, and accelerated the development of next-generation electric vehicles. Losing this partnership means losing both production capacity and technological edge. The setback is not just about numbers, it's about falling behind in a race where every month counts. Now Ford's 2030 all-electric goal looks far more difficult. Delays in battery supply could ripple through the entire production process, pushing back launches and eroding consumer confidence. Every vehicle that was to get a battery from Turkey is now a question mark. Each unfinished car represents lost revenue and missed opportunities in a market that's moving faster than ever. Executives must scramble for alternatives, burning time and resources that should be spent on building and selling cars. The search for new partners and suppliers is costly, risky, and could take years to fully resolve. The collapse shatters Ford's carefully laid plans and puts its European future in jeopardy, forcing the company to rethink its entire strategy at a critical moment for the industry. LG Energy Solutions' exit wasn't impulsive, it reflected growing caution in the EV industry. Slowing EV sales, economic uncertainty, and volatile raw material prices made the Turkey project risky. High interest rates have made borrowing billions for new factories far more expensive. LG is now focusing its investments in North America, where government incentives like the Inflation Reduction Act make projects more attractive. With major joint ventures in the US and Canada, LG saw a safer, more profitable path elsewhere. The combination of slowing European demand, financial risk, and better opportunities abroad tipped the scales. For LG, it was a matter of resource allocation: cut losses in Turkey, double down where the outlook is brighter. Ford, meanwhile, is left scrambling to fill the gap. This isn't the first time Ford's Turkey battery dream has collapsed. Before LG, Ford had a deal with SK On and Koch Holding for the same factory, worth $3.2 billion. That plan also fell apart before construction began, citing financing difficulties and economic uncertainty. Rising interest rates and recession fears made investors wary, and the project was scrapped. Two failed deals in a row reveal a deeper vulnerability in Ford's strategy. Even with agreements in place, financial realities can kill projects before they start. Ford's repeated failures raise questions about its ability to execute critical initiatives. The perception now is that Ford is struggling to adapt to the new EV landscape. This history of collapse makes finding a new partner even harder. The road to electrification for Ford is proving far rougher than expected. Ford's Turkey saga exposes the high-stakes gamble of building EV supply chains. Transitioning to electric vehicles means creating a new industrial ecosystem, securing raw materials, building gigafactories, and inventing new processes. Each step is a multi-billion-dollar risk, made years before a single battery is produced. If forecasts for demand, material prices, or government support are wrong, companies face huge losses. The supply chain is fragile, dependent on a handful of countries for key materials. Geopolitical tensions or trade disruptions can upend everything overnight. LG's pivot to North America, where government support is stronger, shows how policy shapes investment. The result: an uneven global EV supply chain, with some regions racing ahead and others left behind. While Ford's European plans are in disarray, the company faces a crossroads that could define its future on both sides of the Atlantic. In Europe, Ford's ambitions have been hampered by a mix of economic uncertainty, shifting regulations, and a lack of clear government incentives for electric vehicle production. Meanwhile, its North American strategy is thriving, with Ford doubling down on its home market and capitalizing on a wave of public and private investment in EV technology. In the US, Ford and SK On are building Blue Oval SK, a massive $11.4 billion battery venture in Kentucky and Tennessee, one of the largest investments in Ford's history. This project is designed to secure the company's supply chain for years to come. These state-of-the-art plants will power hundreds of thousands of electric trucks and SUVs, including the best-selling F-150 Lightning, and help Ford meet surging demand for EVs in North America. Crucially, the project is backed by billions in low-interest government loans, making it far less risky and giving Ford a significant financial cushion as it scales up production. The contrast is stark. In America, Ford benefits from strong policy support, robust infrastructure, and a government eager to lead the EV revolution. Ford enjoys a booming EV market, with incentives that encourage both manufacturers and consumers to go electric, fueling rapid growth and innovation. In Europe, by contrast, uncertainty and a lack of meaningful incentives have stalled progress, leaving factories idle and plans on hold. This divergence highlights a new reality. Government partnership is now essential for building resilient EV supply chains and staying competitive in the global market. Ford's big bet on America strengthens its home market position, but it also leaves Europe vulnerable to falling behind in the EV transition. Delays in Europe could let rivals like Volkswagen and Tesla pull ahead, capturing market share and setting new standards for innovation. The global EV race is now shaped by where governments are willing to invest, and which regions can create the most favorable conditions for growth. For Ford, the stakes have never been higher. The company's future, and its place in the global EV market, will depend on how it navigates these challenges and opportunities. The Ford-LG collapse forces a tough question: is the electric revolution stalling? Slowing demand, high costs, and fragile supply chains are making automakers rethink aggressive EV targets. EVs remain pricier than gas cars, and high interest rates make financing harder for buyers. Concerns about charging infrastructure and battery performance still deter mainstream consumers. Investors are cautious, and funding for massive projects is harder to secure. The industry is entering a new, more challenging phase. Less hype, more hard reality. Expect more deal collapses, revised timelines, and strategic pivots. The dream of an all-electric future isn't dead, but its arrival will be slower and more complicated. The path forward is no longer a straight line. The challenges are real, but the EV industry can recover if it adapts. This slowdown is a chance to address core issues: cost, supply chain resilience, and consumer concerns. Government support, like U.S. tax credits and loans, is crucial to de-risking investments. Automakers must diversify battery sources and invest in new, cheaper technologies. Reducing reliance on volatile materials like cobalt and lithium will help stabilize the industry. Making EVs more affordable and building better charging networks are key to winning over mainstream buyers. The current storm is a test of resolve. If the industry adapts smartly, the electric revolution can emerge stronger and more sustainable. As of December 17, 2025, Ford faces a critical crossroads. Two failed battery deals have left its European EV plans in crisis. Ford must urgently find new partners or rethink its strategy to avoid falling behind. The pool of top-tier battery suppliers is small and in high demand. Ford may need to pursue smaller, more flexible projects instead of betting on a single gigafactory. It's time to reevaluate the 2030 all-electric goal and adapt to new realities. This crisis is also an opportunity to build a more resilient, diversified supply chain. Ford's response now will define its future in the electric age. The next move will determine whether Ford leads or lags in the global EV race.